So welcome to the FrankBanker interview. Today we have Mr. Arijit Chanda. Arijit is a chartered and cost accountant by qualification with more than 2.5 decades of banking and consulting experience across the cross-functional domains of strategic planning, transformation, risk management, business development, collections, internal audit. It goes on. He has worked in leadership positions in Citibank, Tata Capital, and Fullerton before he moved out and started Samvit Insights 10 years back, based at Mumbai. His illustrious list of clients include leading banks in India and abroad, leading NBFCs, HFCs, international and national advisory firms. So at Arijit, a very warm welcome to you. It's a difficult thing to catch you. So I think the only silver lining that I'm seeing because of COVID is that you are available for a discussion. And today, what I wanted your perspectives on is primarily the post-COVID situation for banks and bankers. So it's unprecedented times. Future is uncertain, and therefore banks are on back foot. Bankers are unclear. And if I have to just compare it with the two situations, one was 1991 when we had a BOP problem. Fortunately, at that point of time, we could open up and get FDI, but at this point of time, it's a global problem, and hence that may not be the solution. Second, of course, was 2008. Again, a large impact, but limited to certain sectors. So for banks, what is the correct or the right direction? What is their strategic approach that they should adopt?
First of all, thank you, Amit, for inviting me for this discussion on FrankBanker. It's a privilege to be here. Yes, I think these are unprecedented times. Frankly, I don't think so since the Second World War, this kind of global impact, panning across borders, sectors, segments, impact has been so severe. And it, encompassing across industries, value chains, all. Specific to the financial industry, which is also going to be severely impacted. I think it's important that the strategic direction will undergo a major change in the future, because your earlier plans, programs, strategic outlook, all has to change because of the high amount of uncertainty that this pandemic has brought about. So I think it's important to understand that the way to look at it is to look at three key elements. The first element is how the customers are affected. Second, how are the people, which is the staff, the families, extended families are impacted. And the third, and not the least, is how is the business and the operating model impacted. So any strategic change or vision has to take into account these aspects. And I think it's about time that there has to be perhaps a totally change in strategic vision and reorientation for banks across financial services, bank, NBFCs, HFCs, SFB, everyone.
Yes, we are very right, Arijit. There is going to be widespread impact on all aspects of business. But you touched upon the customer segments in particular. Now, going a little down further on that discussion, it is obvious, of course, that not every customer in the economy is going to be impacted similarly. Some would be able to tide through a little better way compared to some others who will be much materially impacted. But from a banker's point of view, what do you think are the segments with higher impact? And therefore, the corollary to that question, which are the segments which do you think can sustain better or would have relatively lower impact post-COVID?
I think first and foremost, this is perhaps the only time in my career I can say that the impact is across segments, across sectors. Because in the past, whether it was 91, whether it's 2008, whether it's DEMO, etc., GST, it had impacted some segments more than the other. It would be either an asset issue or a liability issue, liquidity issue, etc. But never except for a situation like war or a pandemic, or where you have everything locked down And once it's locked down, then all interlinkages are broken and impact. Having said that, from the customer segment perspective, I would talk about two things. One, short-term impact, and second, a long-term impact. And the impact in the short term is obviously will be more on self-employed non-professionals than professionals and salary, because there is an intent of the organizations and the government to not only protect lives but also protect livelihood. In the short term, you may manage by doing some pay cuts, increment, and bonus deferments, and you can manage some of the workforces, perhaps focused on more permanent workforce, white collar, blue collar. However, on the self-employed professionals, which are predominantly better off, and some of the segments can come back and you can manage this cash flow for a shorter period. But surely the MSC, the micro small business segment, the tier 2, tier 3, supplier levels, the tier 2s of the distribution chain, most of the MSMEs, which are, let's say, less than a turnover, less than 2 crores, etc., will be severely affected, because they do not have the wherewithal to not be in business for too long. Cash flows getting dried up. Their receivables will also perhaps get delayed over time. So the immediate impact and more severe impact is seen on the small businesses, perhaps the informal segment of the salary piece, which is the people who are more temporary seasonal workforce, perhaps manageable with some amount of pain for the salaried class. Government will obviously be better off. From the private segment, again, the impact will vary between the white collar and the blue collar. But if this gets prolonged, in my opinion, between 3 to 6 months or beyond, then the effect is going to be paramount across, and we were then looking for severe job losses, and which basically means that every customer segment affected. If I look at from the vertical perspective, then you will have corporates and you will have their value chains. Corporates, depending on which sector and segment, how their cash flow positions, profitability, etc., may be able to manage with some cost rationalization, deferments of certain expenses, maybe a slight amount of employee cuts and payrolls. But the downstream those are more likely to be impacted. So more than the larger corporates, I think, which the commercial kind of clients or the business banking clients more affected. But the lowest of the value chain, the MSMEs, are going to be more severely affected.
Naturally brings and leads us to the question, is that banks' portfolio quality is going to be impacted across customer segments. Customers are going to be impacted. And when you look both of these in tandem, the most glaring question which bankers are often asking us, and I'm sure in your interactions with the clients, the biggest worry is, how do we manage collections? How do we manage recovery? What is the new model of collection? Is it going to be same? And you have seen collections pretty closely. So what strategies of collections do you think banks would have to transform or change to adjust to the new reality?
I think you are absolutely on the ball, Amit. I think in terms of, the immediate, since there is as of now from the asset side, a revenue deferral, no new revenue coming in terms of accruals or fee generation. People will hope in managing cost to some extent, but the impact is more likely. With the regulatory dispensation of 3 months moratorium, everybody is trying to guess how it will impact the portfolio. I think at this point of time, your earlier tested, time-tested collection strategies and models may not work because this is not the scenarios where everybody has got affected. Also, the regulation has given us different insights. So the suggestion is, I think the important part is, first of all, how will you communicate? What is it that you will communicate to your customers at this point of time? Because a great part of it will actually boil down eventually on relationship collection. Because at this point of time, the impact, we are not talking about the customers who were delinquent or were marginally delinquent and you manage them. We were all talking about normal customers, which is obviously 70, 80, 90% of your book. Those businesses are going to get disrupted, cash flows are going to get disrupted. So what kind of communication are you going to do? Second is that you need to segment customer at this point of time, as we talked about different customer segments, understand from your past analysis and their past behavior, what kind of industries they belong to, what kind of sectors they belong to, what kind of segments they belong to, what is their likely business impact in the current scenario. So just to give you an example, so if you were a non-essential commodity guy, you are actually shut shop. But if you're an essential commodity guy, you're still having cash flows coming in. So those segmentations, you will have to build your strategies for collection now more focused on his collections that are more likely to forthcoming. So standard EMI collection, because he's going to dip into his savings at this point of time, he's going to make every effort to conserve his money for future managing his business. So you will require a different kind of customer engagement. You will require a different kind of collection strategies. Maybe you have to think through of taking out staggered payments, match with his cash flows. So there are multiple ways of doing it, and it will vary by customer and by customer segment. So those are things that you will have to think in terms of doing that. The other is it also has to depend on what type of asset category it is. So if it is an earning asset and it is not earning currently, then you might be only have to forego current, but as it starts earning, you give it. So you will have a tractor, you will have a commercial vehicle. But if it is, let's say, consumer, if you're given an auto loan, correct, it has a different impact. There will be an impact also on the unsecured part of the loan, especially that unsecured has gone into businesses which had gone now consumed for basic necessities, or an unsecured personal loan which had gone for consumption. He doesn't have now the cash flow to support that. You might see a greater impact there. But I think the important part of strategy which is earlier not there, you may have to bring in a better amount, much better compassion, much better communication at this point of thing, and much higher engagement to understand what's going on in his life and how to marry your collection with his cash flow.
Very true, Arijit. Yes, these strategies have to change. But there is another point that I'm hearing during my interactions with the banks and bankers is people seem to be depending a lot on regulators' flexibility, like the initiative of 3-month moratorium came in. In your view, these changes in either in the income recognition or provisioning is going to be the guiding factor, the crucial factor, or banks need to strategize beyond that, or they just wait for the regulators to give the green signal?
I think it's a combination of both. In the short term, it will be the regulatory mandate or dispensation. But to me, the financial institution needs to plan much beyond, because if the disruption is expected to be next 12 to 18 months, I don't see how a 3-month dispensation will help, because you have to understand that we were not in a situation where our capacity utilization was above 80%. It has come down to 50%, and we need another 3 months to go there. We're back to zero.
True.
So to go back to that may actually take another 6 to 8 months, depending on raw material availability, labor availability, cash flow, enough, bank lines available to do that. So I think banks have to do, and the strategies have to be broken up into what is on my books, depending on the customer, and what is it that the customer needs now on henceforth. Okay, so how do I make sure that I keep him viable while I collect from my past dues as well as what I intend to support him from? So a different kind of differential thinking will be required to handle the portfolio and collections.
Yes, and taking cue from what you are saying in terms of the portfolio and the stress in the portfolio, the immediate fallout that I see, and history is a witness to it, that moment there are events, many times banks would have some knee-jerk reactions, like we witnessed in 2008. Right. So, for example, stop lending one fine day, or buyers themselves, and you mentioned about collection strategies pertaining to the asset versus unsecured. Buyers themselves more towards the select category of customers which are very highly collateralized, but those collateralized lending may not be sufficient to fuel the rebound efforts for the economy as a whole, and more so for the MSME sector. So it's creating a vicious cycle that I want to grow to break the cycle, but I don't have access to capital, and it will again be a long drawn process of recovery. And with this credit restrictions, it will further limit the ability to come back fast. So from an origination point of view, what do you think would be the approach for the banks? How do they take it forward with the portfolio stress and all the challenges that
So I think it is an annuity business, and you cannot just stop the cycle. You have to break this into two parts. One part is how do you help your existing customers? Your existing customers still need to stay and grow. Okay, so if you just stop the funding to them when they require it much more, and mostly they will require this working capital kind of funding at this point of time, you shouldn't stop them. They will have no option. One is to maybe they will become default because they'll try to save some cash, or they will try to go to somewhere else. In that case, you will actually may have a customer and a portfolio attrition. So I think you have to focus your origination is to say, okay, my good customers, I need to support them, which will give me incremental growth in books. So that's one way. The second part on new origination has to be a question of the risk appetite. I'm a firm believer that whenever there is actually a greater challenge, it actually opens up a greater opportunity. So you will have a lot of banks, a lot of NBFCs, HFCs, which will say, no, we will go slow now, because it's not only a function of only asset quality, it's also a question of liquidity. Many of the financial intermediaries supported by banks, correct? So if they have issues on the other side, in terms of funding those balance sheets, they will not be able to. But for the banks which are had been in the market or raised funds and have low cost deposits, also it's a great opportunity. And the best part is that they can actually pick and choose. They can pick and choose, and they can actually pick and choose good customers which are outside available for them who are looking for funding. So it's a great opportunity to grow. But the origination, I think to some extent, will be now sectoral based, segment based, profile based. So from that perspective, I think the origination model in whom to approach, how to approach, many of them will go digital, are likely undergo some change.
So is there a transformation in the skill set for the relationship managers or the sales manager at the operating model level?
Yes, I think it is no more going to be generic for some time to come. So understanding business models, understanding industries, engaging maybe remotely, so many other things, perhaps, because it is not going to be that you get a set of papers and send it across to the credit team. The front line has to become more engaged, more aware, and start doing better filtering in terms of, so that you are able to get better customers. So I think some set of reskilling will be required for the front end team.
So what I'm understanding in my perspective also is that the RM of the past who pushes, who competes and acquires aggressively, may need to add a few more skill sets of deeper industry understanding, remote communication ability, and all those things.
Yes.
One piece. So we've talked about collections, we've talked about portfolio stress and management. We've also talked about origination, and one very important piece, which I want you to share your thoughts, will be on underwriting. And more specifically, last decade or so, we have been hearing more about big data and moving towards algo lending, and more commonly credit scoring models. So are these going to be impacted? Because all your assumptions of the past data being a predictor of the future seems to be getting questioned. So how relevant do you think the behavioral scoring models based on the past transaction data, in terms of their weightages in the scoring models, how relevant would they be? what would be the new script for the credit scoring or objective evaluation parameters?
Okay, my opinion is that, as I said, this is an unprecedented crisis never seen in the past. So if you get in some data models, and especially where the business topic has been, so normally you would say, I look at a 6-month bank statement, I will look at a throughput. So if you start resume businesses in July and you look at for the last 6 months, there'll be no business happening for the last 3.5 months. So the earlier models of assessment, earlier models, so it has to be basically more, I think, a combination of qualitative and quantitative combination, and it has to be perhaps a bit more forward looking than so. It is important to understand that both will be here to stay, but for some time you will have to bring in a greater understanding of the industry, greater segment, greater understand the business and the operating model. From the perspective is that, is this business going to stay? Is this business going to grow? Will the cash flows are reliable and sustainable? And therefore, this lending in the past, I mean, only thing that perhaps you can draw upon in the past is uh, the sector industry, how it has gone through some amount of crises and how it has performed. Perhaps to some extent, the intent of the customer. But you must also understand that many of your customers will have different vintages in the book. So somebody who had a longer vintage pay record is very different. Somebody who originated 6 months gap, you don't have much of a track record. So I think some of surely the way the analytics is looked at, similarly the way the underwriting is looked at, surely the way the assessment is done will change drastically. Will change drastically. Whether alternate data, not on alternate data. So if you look at somebody's, you're looking at a social media. The social media has been having heightened activity in last 3 months, but you may not be nothing relevant to be lot of other things, and it may give you a false positive. So you really don't know, correct? Your bank statements to some extent, some period may not become relevant at all. Your financial statements post demo, post GST had shown very different numbers. So important therefore is that the underwriting, the way you underwrite, the tools that you bring for underwriting has to be changed in light of the new environment. What will be the new world order post COVID has to be taken into account. And I believe that the credit scoring, all this algorithm has to undergo change, and the variables will undergo a change. But now the greater focus will be most on the sustainability and the viability of the business and the operating model from credit assessment perspective.
So I would say the in the gist, two important elements come out of your inputs. One is, of course, credit officers, just like the relationship manager at the operating model level, would need to be upskilled, reskilled, depending on where they are in the product and policy lineup. Also, possibly a little bias more toward judgmental lending in the assessments, credit risk assessments. Possibly the scoring model going towards expert scoring bias again, compared to only the behavioral data. That could be another fallout.
Yes, you will have to perhaps, so you will have, so it could be a semi-custom model. So you could be based on data and based on expert at this point of time, than being fully expert or fully data-oriented model. I think that moderation has to be done in the current circumstances. But you will have, different school of thoughts. People will say, but if it is unprecedented, never happened from the expert. But I presume that the customers' input, the associations' input, the experience of the bankers on the front line must play some role because of how the business is looking forward. Even inputs from the regulator, the government's outlook, etc., must be taken into consideration in the new underwriting scenarios.
So, of course, Arijit, my list of questions is very, very long. So I'm sure we'll be having many of these discussion, and each of the topics that we have discussed today would require an in-depth evaluation of more specifics, whether it be portfolio, whether it be origination models, scoring models, larger underwriting and credit risk assessment. Also on the liability side, the impact that the banks are likely to face. So I'm sure that we'll be interacting more to take these topics more in depth. But my last question to you would be with the Samvit Insights and your interaction with the clients nowadays. How are clients and banks, reacting? Are they articulating any fears or aspirations or strategies that they plan to implement?
So I have interacted with some of my clients, current and the past clients, trying to understand what's going on their mind, how do they foresee the future, and I think there is a great amount of uncertainty. I think the regulatory dispensation given to the end customer is perhaps also for the financial intermediate is not matched by similar dispensation given to them, which could relate to a cash squeeze. Investors' interest to pump in some more money at this point of time, to especially the smaller firm, fintech fund, to keep them liquid. Uh, how will the co-lending piece evolve going forward is also perhaps something
True.
there. But three things are coming to the fore. Uh, what they're asking us is that this is the time where perhaps we will require support on understanding how we can manage the portfolio better that we have, including better collection strategies to manage what is going to come. Second is how do we look at originating going forward? And the last and not the least is that do we relook at the well operating model, both in terms of digitizing, automation, cost rationalization. I think these are the three clear themes that is coming to the fore.
So it was great talking to you, Arijit. Thank you so much for taking the time out. I'm sure these are challenging times, but you've mentioned already that challenging times are also opportunities for people who can organizations which can think through and take it in their stride. So I'll keep interacting with you, and we'll build up deeper perspectives on backing. Many thanks to you for joining us today.
Thank you, Amit. It was really a pleasure interacting with you and sharing the perspective. And we look forward for many more of such engagements and sharing our perspective, which can help our clients. Thank you very much.